Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel. And today we have an amazing guest with us, and Mr. Alex Donnolo from Mavdon Investments. Before we get started, I want to ask you a real quick favor. If you're getting any value out of this podcast, would you please go over to iTunes and leave me a review? It means the absolute world to me, and I promise I'll keep recording if you keep posting reviews. So thank you so much for those reviews of the show. All right, let's dive in. Alex is the founder of Mavdon Investments, founded in 2019. He has a $15 million portfolio of commercial real estate totaling over 600 units with a specialty in mobile home parks and RV parks. Welcome to the show, Alex.
Yeah, glad to be here. Glad to be back. Thanks for having me.
I was just looking at our previous episode earlier today. It's been 2.5 years since you've been on. I know a lot has changed, but maybe you can start out by just telling us a little about your story, reminding us kind of how you got into manufactured housing communities, and then maybe tailing that with how Mavdon, what's changed in the last 2.5 years since we interviewed you and Dylan.
Yeah, I would say mainly just more tattoos, but no. Yeah, so I'll start with your first question, just a quick run through on my trajectory, how I got in the space. I started in construction. That was my first dabble in business, not being an entrepreneur. Right out of high school, started my construction company and just sort of was self-taught, had some mentors in the space, but was self-taught, a lot of YouTube. And then I started, through that, I was practicing sales and negotiation and how to run a business and grow teams. But I was still trading, time for money. And so eventually I started flipping houses, except I was bootstrapping every project, doing the work, funding so again, I was trading time for money. And I was like, oh, there's got to be a better way. By my early 20s, I started hearing about wholesaling online, watching videos, studying, jumped into that and got really gung-ho about it. Started doing deals all over the US. And that's how I met Dylan. We were at, going to expos and stuff. We met at an expo and we both had big visions. We were both young and driven. And we complemented each other really well. Dylan was very detail oriented, operational. He was good at growing and managing teams. I was kind of vision driven and, hey, I'll go get investors and find, and I'll build kind of the big vision. And so we started moving pretty quickly. We did over $1 million in wholesale fees together pretty quickly in like about a year and a half. And then as the story goes, we bought our first mobile home park in 2019 and kind of never turned back. We started buying up the whole block of mobile home parks and just really trial by fire. We learned so much. I mean, we were physically flying out there. This was in the Midwest, us living in the Pacific Northwest. We were going out and, personally interviewing site managers and knocking on doors and serving notices. And it was great because that first deal is always exciting and, you have a much more intimate relationship. And so we got a really in the trenches style crash course and learned a lot. And then, started putting content out there. And that's really how we gained attention from investors. Passive investors was really, a lot of internet work stuff that got us probably our first 3 or 4 deals. And then after that, it was just through Facebook and coming on these podcasts and sharing our stories. And so Dylan and I still get along great since the transition. Actually, I'm possibly buying a wholesale deal from him right now. And yeah, it was just I wouldn't even say creative differences, but just kind of sort of different goals. We had different goals and what our personal lifestyle goals were. So then that created different business goals, and it just made sense to sort of dissect things. So we still champion each other. We still do deals together. And so for me personally, as far as where I'm at now, after going out on my own, I sort of, I'm very creative. I'm a visionary. My mind's always going. So I did sort of, I had to build back up my team, get back into acquisition mode, been buying mobile home parks, but I also venture off and get these itches to buy like lifestyle type projects and Airbnbs and RV parks. And like I mentioned to you before we started recording, every time I do that and I run the numbers and I do underwriting and I try and determine an exit strategy, I'm just like, man, this is why we're in the mobile home park industry, So it's just a testament to that of, yeah, it's fun to, do these other projects with, maybe more sexy asset classes, but tons of turnover and more questionable horizons. And so, 2024, we're up, like you said, up above 600 lots again, and we want to double that strategically. We've tightened up our criteria a little bit. It was sort of anything and everything before. As I think Dylan's mentioned, it was like wastewater treatment plant, we'll take it, anything, let's learn, let's get some deals under our belt. Now it's, okay, let's refine that criteria and be a little more specific. I'm not very market specific. I still buy anywhere, just more deal specific now. So
maybe tell us about that. What does your, mobile home park investing strategy look like now compared to, back in 2019 when you bought that first deal?
The biggest thing is I really like to keep it as simple as possible. I mean, you can call it a needle in a haystack deal, whatever you want, but I tend to find them. But I like high occupancy. I have not mastered the infill game, and I will, admit that wholeheartedly. It's just not my cup of tea to be dealing with all that. And as time goes on, and I have executives running in the leasing department and stuff, then we'll look more into that. And of course, we always have marketing out there, and we're always doing infill. And in certain areas, it's a lot easier to have people move their own homes. Like Texas, people just show up with their mobile home, be like, hey, I'm here. Like, where's the site? But we're not buying and renovating homes and doing all that. So I like a 60% occupancy. That's a new metric. And for that same reason, I used to be bullish on park-owned home conversions. I don't care how many park-owned homes there are. We can convert them to tenant-owned homes, and that's just gotten more difficult over time, I feel like. And so we just say it's tough, but right now we're saying no more than 5 park-owned homes. And obviously we flex on that a little bit, but it's just sort of a criteria
Yeah, I think that's like something in the last few years that a lot of operators kind of got lenient with. But like from my experience, when you buy a park with a lot of park-owned homes, and maybe you can shed some light on this as well, like there's turnover. Like some people don't want to own the mobile home. They just want to rent. And so you're going to have turnover, and these homes don't come back to you in crystal clean condition. So, we bought a park, 136 lots, all park-owned homes. And, the turnover has been, I'd say probably a third of the tenants, over the course of a year now are turning over, right? And we're getting the homes back. So you got to have a lot of crews to get these things rent ready and then sell them. And, in some markets, Midwestern markets, the absorption rate, you're not going to be able to sell 20 homes a month in certain markets, right? Like, so it's just, without getting bad eggs in there. So that's just it's been tough. And that's one thing that we've gotten a little bit more specific on is less park-owned homes as well. But I'm curious of your experiences.
Yeah, same thing. I mean, because it's easy to say, well, no park-owned homes because of the maintenance and all that. But yeah, the turnover is the biggest benefit for me of the tenant-owned homes. I mean, those tenants stay forever. And yeah, I mean, Mascoutah is a prime example. The first park we bought, it was like 22 tenants, and we only had 1 park-owned home. And that 1 park-owned home to this day has caused more problems than any other of our parks. I mean, we've had like 20 different tenants in that home. It's been remodeled countless times. And so, it's like that was a prime example of, and then we still kept buying park-owned homes. And we have one park in Toledo that, well, Dylan took that over in the transition, but I would say it was about 50% park-owned homes. And we missed the mark by like probably a year on that one, and just how long it was going to take to convert those, what the responsiveness was going to be from those tenants. And yeah, that's the one thing you're banking entirely on speculation as to how they're going to react when you try and get them to buy the home or even give away the home. Cause most time they're not in that great a condition to begin with, or they're older homes. And so there's just, especially, and then you're buying older homes and you're opening up that park specifically in Toledo, I mean, we were doing electrical work. We had to redo all the electrical, the plumbing. I mean, at that point, it's just diminished returns all the way around. And so, yeah, I know guys who, if they have great systems in place, then they've got ways to make that a very lucrative part of the business, especially infill, converting vacant lots, doing infill, adding values. It's great. It's just not my cup of tea right now,
Yeah. And we do a lot of infill, but there's no like secret sauce or anything. It's a lot of work. It's a lot of project management. We have 4 full-time project managers that's all they do, right? Like on new projects, that their whole job is to find homes, get them brought in, get concrete work, get utilities hooked up. So it's just a ton of work, and it's expensive, right? These aren't, you can't outsource that. These have to be US based people that are going to spend, a week out of the month on site meeting with these contractors and making sure that it's done right. So
absolutely,
it's a lot of work. Yeah. So I applaud you for kind of realizing, hey, this is outside of my lane. This is where I'm at. This is what I'm good at. And hey, an infill home here or there is great, but big, huge 20 plus home infill projects is opportunity cost, right? Like if you can buy something else over here and it's just lower hanging fruit, easier turn and burn than buying something that's a big project and is just going to require, 60, 70% of your time, it could be more profitable. So,
and that's exactly what I'll say, just to touch on that. It makes for easier conversations with my cash providers, with my lenders, investors, because, in the past, it's like, okay, well, here's the projections, here's a business plan, okay, by this quarter, we're going to ideally convert this many park on homes. And then it's like, okay, quarterly reports come out. And then everything else, we hit all our other financials, everything, but those park on homes are that one thing that's like, oh, we're kind of missing that target. So why not just make sure that worst case scenario, if I do everything as is, and count infill as the cherry on top, or anything new, like you said, as a cherry on top, and the deal still crunches and we still meet our cash on cash return, then great. Then that's a great deal. I know that we can push, to increase that occupancy, and that's going to make it even of a better exit strategy kind of deal. But I just don't have to bank on that speculation.
Yeah. And I know you buy a lot of smaller parks, or you have in the past. Tell us about that and how you get that to work in some of these, tertiary Midwestern markets.
Yeah, 100%. To be honest, the reasoning for that is more for, I'd love to be buying bigger parks. I do like the easy due diligence. For me, it's easier to take, sort of a small development or acquisition fee, like a $25,000 acquisition fee, and do 4 deals a month or 3 deals a month kind of deal, than try and bank everything on one big project. And so especially, and then with my team size, as we're scaling our team right now, it's a lot easier. I like to be a lot more thorough these days on due diligence. I don't want to miss anything. And so, and then the second reason is I have sort of a unique funding strategy in that I'm not doing syndications or funds. I do all seller financing. And then my cash providers come in as second position or third position private lenders. And I've been able to do that just by working with a lot of newer investors, people who see my track record, newer lenders who are like, and I have to explain to them the nuances of the tax differences of being a lender versus an investor.
Maybe you can go into that.
Absolutely.
The second and third position liens on the real estate, is that their collateral? I was saying, so your cash providers, your equity providers, are second or third position liens on the property, on the real estate itself.
Yeah,
like recorded positions.
And the way that I incentivize them to do that is with really high interest. Typically 15%. That's just fixed 15% annualized interest, and then monthly installments. There's no equity. And then the way that, sometimes as you get into the more sophisticated investors and the higher check writers, the higher earners, they need those tax benefits. And so in those situations, still, I'll only work with maybe one cash provider, and we'll just do a partnership. They will get roles and responsibilities within the operating agreement. And they will get, their equity, but I don't do any hurdles or anything like that. I still set them up with a fixed interest, because that's really, at the end of the day, what they want to know is we're all in this for stability. We're in this the space for stability. So remove speculation from the equation. And, as I get into bigger deals, the reality is it would just make that model a little more complex, and so this has worked for me. And then it's just buy more deals kind of deal and tighten the criteria.
And I totally get it. I think the biggest misnomer about small parks is that they're harder to manage, right? And I think that's 100% dependent upon the on-site manager that you can find. And if you can find a great on-site manager, you can make a small park work every day of the week. I'm under contract right now to buy 2 small ones. They're one's 30 lots and one's 32 lots. They're near or in the vicinity of some other bigger parks that we own, but I'm going in at 11 caps. Like these are 11 caps day one off current occupancy, current income. And it's like, okay, I can make this work. Like I can pay my on-site managers a little bit more and still make this deal work. So I do think that there's a niche there. But yeah, it's going to be, it probably will be a little bit tougher to manage. And in terms of the management income that you're getting in the property management company for.
And like you said, the exit strategy, it's like, all right, you're in a bit of a smaller market, and then with, but one thing I will say is, like you said, there's oftentimes these are more ma and pa, there's more meat on the bone. I mean, we're still doubling the value of these. We've hit our exits on these, and sometimes we just need to sell, rather than refinance, we sell. But a lot of times, even on our refi products with these smaller parks, we're working with local banks. And we can, and we can still get solid terms from local banks, or we can just sell, a lot of it works if you're buying 4 small deals to sell 2 of them and refinance 2 of them kind of deal, dependent on. So we just, we're always being very proactive about our exit strategy and just making sure we drive value out the gate as quickly as possible. But yeah, like you said, especially when you're buying in various markets, it boils down to the systems you have in place for your management team.
Totally. Alex, tell us about your most recent mobile home park acquisition, when that was, what did it look like, so forth.
Yeah, it was just recently, let's say it was October was the recent mobile home park, 35 pads, about 800,000 seller finance. Can't think of the exact terms off my head, but it was good. 5% interest only and 3 years seller finance, but it's in a tornado zone. It's in Lubbock, Texas. And so that was my first deal buying in a tornado zone. I worked with one cash provider on that deal. We both are bullish on Texas, and everything about this park made sense. Fully occupied, 35 lots, fully occupied, very undervalued lot rents.
City water, city sewer?
All city utilities, 180 on the lot rents.
Wow.
Market realistically is like 275, 300. And so we're going in, and it's really, they've just been deprived of management, deprived of groundskeeping. And so we're going in and doing a 6-month push. That's kind of our typical protocol, do a 6-month push to improve management, improve the systems, fix any potholes, attend to any needs of the tenants, and then, start giving out notices for the rent raise plan. We've already given out our first notice, and there's been good responsiveness to that. So it was one of those things where, we just did a lot of research. When was the last tornado? What is the risk factor here? Looking into the insurance. What's that?
How'd you find that deal?
That was through a wholesaler. Yeah. And I will say right now we're not doing any cold calling. I'm starting to build a cold calling team again. But I've been pretty lazy right now. It's like, I'm on all the email lists. It's so easy to just pick up wholesale deals, work with those guys. I get pocket listings from brokers. This was a wholesaler that I work with quite a bit who sent me this.
Nice. And we talked about park-owned homes earlier, but what other mistakes that you've made in mobile home park investing do you think we could learn from?
Yeah, great question. I think Dylan's touched on it before, but just not properly inspecting utilities. I mean, that's such a big one.
Yeah.
Understanding that, not getting multiple quotes. We work in various markets. We subcontract out pretty much everything. And so a lot of times it's a rush to get due diligence, to renegotiate with the seller. So you kind of get that first quote back, renegotiate, And then when the next quote comes back, it's twice that, and you've already closed. And, and so it's making sure that you've actually used your due diligence time to build your grounds team. That's something we've not done in the past. And so now, that's the first thing we do, before inspection expires, is make sure that we have, if it's a new market, that we have all the contract. We've had 3 quotes for everything, and we've collectively as a team picked out which contractors we're working with. And then we go back and do any renegotiating with the seller.
Gotcha. And you manage all the operations in-house, like any project management, any property management, it's all in-house. And what is your
everything's in-house, through our management team. Yeah, we have project management, construction management, leasing department, and upper management in each of those, and then VA assistants as well. We work with a lot of VAs. So
okay. So how many people are on your team now?
14 right now, including VAs, and not including site managers, obviously. Yeah.
Nice. Alex, what do you think are the most important things that passive investors need to look out for when investing into mobile home parks?
Yeah, it's a good question. I knew you were going to ask that, so I prepared for this question, because one that's been asked to me lately that I never thought about, to be completely honest, is what do you do if shit goes wrong, basically? Like, how do you replenish the capital? Because I never thought about that. I never thought of but for the most part, we've never had to do like major capital calls or, had to stop distributions or anything like that. So, I've heard war stories from partners coming in. Well, this happened in the past, and they brought other people in and they diluted our equity. And my mindset around that is I just have such gratitude for my cash providers that if anything went wrong, it's no question that I would find a way, whether I had to dig into my own pocket, refinance my house, whatever. I personally guarantee all of those promissory notes are all personally guaranteed. So I started explaining that in my pitch, that's very clear. Just so you know, here's what happens if something does go wrong. If I can't make a return, that comes out of my pocket. I don't take any fees. I just take, I just get surplus proceeds after all debt providers have gotten. So these are debt providers. They have to get their interest. So I think that's an important question.
I think we should touch on that too, just real quick, is since they're debt providers, they don't get depreciation. But sometimes you said you do allow a split of equity so they can get some depreciation, because the tax benefits are something a lot of the LPs that I talk to are really interested in.
Yeah, it just depends on who I'm working with. I'm very clear. So that was the second question I was going to go into, is making sure your goals as a cash provider as to what you need for tax purposes. Because if you are someone in need of getting some tax benefits, then you're not going to get that as a lien provider, as a debt provider, right? You're 1099, and that's pure income. You're being taxed on income. So with the more sophisticated investors that I work with, so I'm always very clear, here's the reality. But the benefit of this is, you're going to get your fixed interest there. These are a lot of guys who individuals who are used to getting their 7% in their 401ks or in a high yielding savings account, 4%. So to go from that to 15% is very incentivizing. And then they have to understand the risks associated with, okay, but I'm seller financing this, you're second position if there's multiple cash providers, you might be third position, right? And here's the legalities of that and how that works. So it boils a lot down to trust. It also boils a lot down to, a lot of times we're only putting in 50 grand or 75 or 100 grand. Because I only need 300 grand, right? And then I still bring, I'll cover the 50 grand or whatever's left over kind of deal. And then I build their trust, and they're like, hey, this worked out. Let's do another one. I can also, it's not even syndicating without syndicating to give them equity post refinance, right? After they get liquidated at the end, I could give them a promise of 10% equity after that kind of deal, right? So that's something I'll do as well. Hey, so let's do a 1 year. Also on these smaller deals, I can do shorter horizons, 2-year turnarounds. We've been pretty on target with hitting our marks with 2 or 3 year seller finance deals and refinancing or selling within that window. If I do refinance, a lot of times I'll promise my partners equity post liquidation as well.
Interesting model. Very interesting
Yeah,
model, which it definitely works with probably,
but
since you need
very
such little
certain.
amount. Yeah, you need such a little amount for per deal that could work. But that's interesting. Yeah. So as an LP, you definitely want to look into the deal structure and kind of fully understanding that, because this is one unique way to structure it. What else? What else, Alex? If you were a passive investor looking to invest in another GP or something into a mobile home park, what would you tell them to look out for? What would you look out for?
I think just I think doing your own due diligence on the park. I think it's probably been said on here before, but if you're not investing in a fund, if you're investing in an individual deal, I think it's vital to, because this should be a learning lesson. Unless you're truly just you could go invest in Vanguard if you wanted to be completely passive, completely disconnected, and that's not the experience that I try to create, because most of these individuals are like, hey, I want to learn, I want to get into this. Like, hey, cool, you know, come partner with me and we'll learn, and it's a win-win for both of us. And so it depends definitely on the demographic. As you get into the more accredited investors, they really are just looking for that lucrative return on their investment and those tax breaks. But I think us operators, we are obviously inevitably going to be somewhat biased. We want to close on the deal, we want it to go right. And so I think my cash providers have brought up things that I didn't think about. And they say, well, what about this and what about that? And I go, yeah, well, maybe I should, or do you really think we're going to hit that cap rate on the refi, and then maybe we should adjust that. And I'll go back and adjust my underwriting, and I feel a lot better about it. And I'm like, hey, they truly brought value to this by doing their own due diligence. And then they trust me in that, okay, he's going to like own up to, maybe when things do go wrong, we're going to quickly adjust, and he's not going to be too prideful to make an adjustment and be agile. So I think there's nothing wrong with auditing and doing your due diligence. Of course, you got to trust the operator, but the deal is just as important,
Totally. Totally. Yeah. I think understanding, the deal structure, not waiting until you get your K1 the following year to kind of say, oh, geez, there's not a negative number on here. What I thought this was something different. So that's important. Alex, what does the perfect mobile home park look like in your eyes, and why?
Fully occupied in, the Sun Belt, year-round market, and year-round warmth and sun, no frozen pipes, and then at least high 80s or low 90s plus age homes, and a live-in Rockstar management, public utilities, paved roads. I have one in Texas. It's been a great deal. It's a beautiful park. All the homes are 80s plus. We're on all public utilities. We've got covered carports on all the driveways, and it shows. Our tenant demographic, the energy of our tenants. They're just in a better quality of mood, and so like that goes a long way for. I think the value of your park is like how is the overall feel, the vibe, the demographic. And so those small amenities matter. We don't have any like high class parks with pools or anything like that, but just anything with small amenities, trees, shade, picnic tables, common areas, dog parks, keep your tenants happy.
Yeah, you kind of can tell, right? Even on Google Maps, if you're doing a drive through of a community and it just looks, it's not perfect, right? But it looks semi clean and well maintained. Likely, from my experience, that's how it turns out, right? And the investment turns out to be that way. But in the ones that kind of look ratty and just really, super low income, and the homes are kind of falling out of disrepair, those are the hard ones. And we've passed on so many deals that penciled out at super high cap rates this year, but the average age of the homes was really old. They were smaller homes. And from experience, you're just going to have higher turnover in those types of parks. And, in the early days, it was like, oh, we got a $15,000 rehab budget for every park-owned home. We'll be fine. It doesn't matter. You could put $15,000 and put lipstick on a pig, but it's still a pig. And your turnover, no one's going to want to live in that 12-foot wide home for longer than 3 months, especially if it's in a northern state and it gets really cold and there's not a lot of insulation. So we've learned the hard way on a couple of those as well.
Well, until you've been inside some of those yourself personally and seen the layouts and how they're configured, and you're like, oh, wow, we thought people could really live in these, and I've heard it said on this podcast before, but it's like, yeah, that's fine. Even if you renovate it and make it look nice, what happens if you truly are going to hold this for 5 or 10 years when those 60s homes eventually, like, they turn to dust, and it's like, and then it's a far more cost than even a vacant lot at that point.
And I've slept in a mobile home for a summer, and you don't realize until you're in one how thin the walls are, how thin the floors are, how the walls with a lot of wind or a storm, how you hear every raindrop and you kind of feel the walls, moving in an older home. So it's just a different respect, when you've lived in one for a while on an air mattress, in one of the bedrooms on the floor. But,
yeah, I commend you for that. I commend you for that.
Yeah, it was a adventure, big project up in Iowa. But Alex, what do you think is the biggest threat to mobile home park investing?
I think what we just touched on, I think the age of these homes, because as we lose existing homes and replace them with $100,000 homes and $160,000 homes, and we have these grandfathered parks that we can't bring new homes in or whatever the case is, and we have all these new apartments going up, and I just think that's the biggest concern, is trying to protect that diminishing supply. And of course, it's like, there's a lot of moves being made, but as costs go up, and again, the cost of these homes, like we talked about, it's just not sustainable in certain markets. And so that's where the RV parks kind of came into play, was like, we don't like the transient or the short term, but even just supplementing that, if you can get away with that, depending on the ordinances, where the park is, bringing in RV sites is a great option. And, doing monthly, supplementing that. We've been able to take maybe an 85% occupied park in Texas and just take that other 15% and designate it as, at the same monthly rate as the mobile homes, but do it in RVs. I think, with the economy and the interest rates, I really only see that helping our case right now. I think there's going to be a lot of trading going on. I think we're going to have like that second cycle is like there's still mom and pa's, and then there's also us operators that are kind of selling to the next set of operators, and I think there's a lot of, as financial distress, not only does that help the demand for the affordable housing, but there's going to be more distressed sellers. We're going to be wholesalers going to be getting some more juicy deals again. So we're actually ramping up cold calling. I think that's my biggest concern, is just supply right now. So it's like, all right, let's start our acquisition team back up and start doing our own, turning over our own rocks kind of deal.
Yeah, no, that's always a good idea, because there's always deals out there to be had. Well, Alex, how can our listeners get a hold of you if they'd like to do so?
Either Instagram, just Alex Donnolo, or my website, alexdonnolo.com.
Okay, awesome. Well, thank you so much, Alex, for coming on the show. Really appreciate it.
Absolutely. Thanks for having me back. It was a pleasure being here.
Awesome. Yeah, for sure. That's it for today, folks. Thank you all so much for tuning in.
Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram at Passive MHP Investing for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's at Passive MHP Investing on Instagram. See you there.